Economists at Goldman Sachs expect home prices to resume their decline, calling today's bullish housing data a false bottom. But Bank of America-Merrill Lynch disagrees, seeing sustained improvement on the housing front. Ethan Harris is head of North America Economics at Bank of America-Merrill Lynch. He joins us now with more on his outlook. Ethan, good to see you again. Thanks so much for coming in.
Thank you.
Where's the disconnect?
Well, I mean, clearly there is some artificial strength in the housing market right now. We've got this tax credit that's helping boost some of the data. You've also had some slowing in the foreclosure process that's probably helped the housing market. So some people do believe that the improvement we're seeing is a fluke. Right. I disagree. I think there's something more fundamental going on here.
Well, Alex Phillips of Goldman said in a section of his report, he said much of this strength seems to have been policy-induced.
Yeah, and I think in the near term, some of the strength is policy-induced. But I think we need to step back and think about where we are in the housing crisis right now. We've had home prices drop to levels where, for people who can get credit, their homes are highly affordable. We also have a situation where buyers have been waiting for prices to stop falling, have all been sitting on the sidelines waiting. When's a good time to buy? Those buyers should be coming back into the market
sometimes
now.
You stay on the platform too long and the train's left the station.
Exactly, and it made a lot of sense for people to be very hesitant to buy a home over the last 2 years. It was, frankly, a bad investment in most markets. But once people start to sense a bottom, those bottom feeders come back into the market. And I think that is part of what's going on now, and I think that's why we'll probably see a further improvement.
Ethan, where's the sweet spot for home prices? There's pluses and minuses, of course, to higher home prices versus weaker home prices. So how far are we from that level?
Well, I think that at the national level, going into this crisis, home prices were about 20% overvalued, and now they're probably roughly equal amount undervalued if you kind of look at the national housing market. So that means that while there won't be a big recovery immediately, at some point over the next 3 to 5 years, we should see a sustained rebound back to the middle of that range of prices.
Are home buyers right now, as you seem to intimate, are they accepting the decline in prices? Do they understand that it's in some instances nothing that they have done, but there's this national tidal wave of home prices dropping and continuing to drop, regardless of the data that we've seen, a 3-month 20-city Case-Shiller index showing that at least we've had 3 months of strength. But do home buyers get the sense now that my home is devalued?
Yeah, and I think that there's a resistance to that at first. The idea that my home can't be devalued. My neighbor sold his home at a higher price. Why can't I get the same price? But I think what's happened.
Why can't they?
Well, I think they can't get the same price because the market was overblown and we had too easy credit. And now we've adjusted to that. And I think, in fact, we've overshot. Prices are now probably too low on a sustained basis. But I think that acceptance of lower prices is what sets you up for the rebound. The fact that people have marked down their homes to levels at which they can sell, that's the basis of the beginnings of some kind of rebound.
Hate to beat the tax credit question to death, but what's going to ultimately happen if it doesn't sounds like, if I'm not mistaken, it's not going to be extended, correct? What's your feeling on that? And what's going to sustain the housing market going forward so that it finally adds to GDP and isn't a burden on the broader economy?
I guess my feeling is that there will eventually be an extension of the tax credit because it's not actually that expensive relative to all the other programs that have been introduced. But I realize that it's running into trouble in Washington. This is, of course, one try. They can always come back for more. I think in the next few months, absent a tax credit, the improvement we've seen in housing will kind of level off a bit, but I don't think that's the beginning of a retrenchment. That's kind of the market taking a breather. As the economy continues to grow, I think there will be some kind of pickup in home prices and construction.
Ethan, do a lot of people get a sense of just how much that $8,000 tax credit has helped the situation? It's akin to the autos and cash for clunkers, correct?
Yeah, it's not quite as powerful as the cash for clunkers, which was kind of a once-in-a-lifetime deal.
Yeah.
But it's a powerful stimulus, and it clearly, some of the strength we're seeing now is artificial. It's induced by this tax credit.
Yeah.
Consumer confidence was weaker, and that was surprising to a lot of people. Could this be another curb to housing recovery? I mean, just the whole psychological outlook, how people, you mentioned, view their home values right now.
Right. So, I mean, there's some big headwinds in the economy. The consumer confidence is telling you that people they're nervous about the job market. They're nervous about gasoline prices. This is not going to be a consumer-led recovery. It's a recovery that's led much more by sectors that have collapsed bouncing back, like inventory investment, and by unbelievably aggressive monetary and fiscal policy. But it's going to be a recovery that has to fight its way through these headwinds.
We're going to get an adjusted third quarter GDP right later this week. 3.2 is the survey forecast. Where do you stand? What do you think we're going to see?
So we have 2.5.
Okay, a little weaker than the forecast.
A little weaker than the consensus. We think there's a little more of a downward adjustment in inventories in the quarter. Fundamentally, I think we're looking at a 3 to 3.5% economy going forward. This is by the way, a very feeble recovery compared to normal business cycle recovery.
So that V-shaped recovery is totally discounted at this point.
Yeah, a V-shaped recovery, a true V-shape looks like a check mark. It's where you collapse and then you have 7 or 8% growth coming out of the recession. This is a baby V. This is collapse in the economy and a 3.5% recovery. This is not a real V.
Ethan, might I ask you in our last 30 seconds, 20 cities covered in this S&P Case-Shiller index. The biggest month-over-month gain in home prices was in San Francisco. Does this bode well for the California market? They've gotten battered in this housing crisis.
Yeah, and I think that's a part of the story here is this kind of bounce off unbelievably low valuations. That's a big part of the story. And so some of the markets that have been beaten up the most are where you're seeing a little bit of recovery.
Ethan Harris of Bank of America-Merrill Lynch talking to us about housing and home prices. Ethan, always good to see you. Thank you so much.
My pleasure.